Hey guys, Tony here. Welcome back to the channel. In this video, I'm going to be giving you what is probably a different perspective on the proxy statement for AMC than you might have heard from some of the pumpers or the trolls. This meeting is going to be held on November 8th. The proxy statement was released on this previous Friday. I'll put a link to it in the video description. We're going to be going over my due diligence work on this, and just to get a couple of housekeeping items out of the way. Yes, I am currently a shareholder of AMC, and no, nobody pays me for any of my opinions. Everything that you're going to hear today is my own due diligence work and my own original thoughts. I will not be telling you how to vote on any of these items. I'm here to share my information. It's up to you to decide how to do your vote. Neither will I be talking about how I plan to vote for any of these items. Now let's get right into it. We have 8 items that we are going to be voting on in November, and I encourage each and every one of you to read through this entire proxy statement yourselves. It is a lot, but that is part of being an informed investor, is making sure that you do your own due diligence work. For those that don't want to read it or just want a synopsis, I'm going to provide, again, as I said, maybe a different perspective on these 8 items than you have heard elsewhere or will hear over the coming weeks. As I read through these proposals on Friday, and then again a second and third time this morning, I had probably the same questions you guys have. Why? Why are these proposals on here? Why now? So that is kind of the focus that I want to talk to you about. What do these mean? Why are they on here? The answer to the why was given to us by the company on page 39 of this proxy. And if you'll humor me for a moment, I'm going to read some of the highlights of this page for those who don't want to read the entire thing. But again, I urge you to go read the entire thing yourself. But for those who don't want to, what AMC tells us is that in response to low participation rates and unfavorable votes at the 2022 annual meeting, the company undertook meaningful efforts following last year's annual meeting to conduct outreach to substantial stockholders in order to solicit feedback on a number of topics, including executive compensation and corporate governance. During the past year, members of senior management and independent members of the board held meetings with the company's largest stockholders on a broad range of corporate governance topics. And surprise, those ended up on the proxy. During 2022, institutional investors held only 25 to 30% of our outstanding stock, with the balance held by retail investors. Meetings were requested with all institutional investors holding more than 1% of our outstanding stock, and held with institutional investors holding approximately 12% of our stock in the aggregate. These meetings yielded a highly constructive, thoughtful, and productive dialogue on all sides. And as a result, the company has undertaken a number of actions to address concerns raised by stockholders. So what they're telling you is that a lot of what you're seeing on this proxy statement is a result of outreach that they did to large corporate institutional shareholders over the last year. And we'll spend just a minute going into some supporting data to see if that is true or not. They go on to say that while the failure of the 2022 say on pay vote was a major factor leading to the additional outreach, once the conversation started, we learned that our largest stockholders, while certainly holding opinions on executive compensation, were much more focused on corporate governance improvements they believed the company should pursue. Again, touching on the corporate governance issues. Although our large and diverse stockholder base with limited institutional participation can make it difficult to ascertain a consensus among our stockholders, as a result of the meetings with large stockholders, certain common concerns were identified. In response, the company has undertaken the following actions. So what they're saying is they went into these talks with the large shareholders expecting to get an earful about the executive compensation, and what they heard instead was concerns about corporate governance and diversity. The first thing that they talk about here at the top that I have highlighted, what we heard from stockholders, concern regarding the lack of diversity on the board of directors. What have they done in the last year about that? They appointed 2 new female directors to fill open board seats, bringing female representation to 1/3 of the board. In addition, they adopted a policy on director candidate diversity to ensure consideration of diverse candidates for open board seats. The next item raised by the large shareholders was concern with the classified structure of the board. So the action that they took was the board has proposed and recommended an amendment to our certificate of incorporation to declassify the board and elect all directors on an annual basis. We'll go back to that's proposal number 1 in just a minute. Item number 3, concerns with restrictions on stockholders' ability to take certain actions. What did they do about that? It says here the board has proposed and recommended an amendment to our certificate of incorporation to remove the prohibition on stockholders acting by written consent. The board has also proposed and recommended an amendment to our certificate of incorporation to remove the prohibition on stockholders' ability to call special meetings. The final item was the concerns regarding executive compensation. What did AMC do about that? They froze CEO base salary and bonus opportunities in 2022 and all components of CEO compensation in 2023. With that framework in mind, let's talk about these proposals as quickly as we can, starting with proposal number 1, the proposal to declassify the board of directors. In a nutshell, declassifying means that instead of the current structure where only a couple of directors come up for election every year, so you have 2 of them this year, 2 of them the next year, 2 of them the year after that, all the board of directors will be up for re-election on an annual basis. And that follows on with proposal 2A and 2B. If proposal 1 is approved to declassify the board, then you will be voting to elect all of the current board of directors to 1 additional year on the board. If proposal 1 is not approved, then just the 2 who are up for election this year, Denise Clark and Carrie Putnam, will be up for re-election. Over the years, activist investors have been pushing public companies to declassify their boards. And as you can see highlighted in this article from August 2022 here in blue, whereas in the year 2000, 60% of the S&P 500 companies had classified boards, only 12% did in 2022. Only 43% of the Russell 3000 companies have classified boards. Up here in yellow, it says one topic that often comes up when discussing board refreshment and board diversity is the existence of classified boards. Critics say that classified boards are not in the interest of shareholders because the anti-takeover effect of a classified board can entrench management and discourage attractive takeover offers, while also discouraging accountability for the actions of directors. And certainly if you have the ability to elect or kick out each and every one of them on an annual basis, that gives you, the shareholder, a lot more say over the board of directors. Similarly, shareholder activists have been pushing public companies to make additional changes, and we see some examples of that in proposal number 3 and proposal number 4. The proposal to eliminate the prohibition against stockholders acting by written consent, and the proposal to remove the limitation on stockholders' ability to call special meetings. By eliminating this prohibition and this limitation, the board of directors is giving you the ability to vote, to have more say, the ability to act between annual shareholder meetings. And if you really want to get nerdy on this, I'll put a link to this 44-page white paper entitled The Never-Ending Quest for Shareholder Rights, Special Meetings, and Written Consent. Go read through that. You will get all of the information you could ever want to know about these two topics and more. Let's move on now to proposal number 5, to approve an amendment to our certificate of incorporation to expand the exculpation provision to limit the liability of certain officers. I know that this is going to be one of the more controversial items on the proxy statement. And again, a reminder, I'm not here to tell you how to vote. Vote your conscience, vote your heart. But in my own search for information, I looked up a couple of legal briefs to understand why was this on here in the first place. And I will put links to the articles in the video description for you to go through and read at your leisure. This first brief tells us that prior to August 2022, Delaware corporations were permitted to exculpate directors but not officers for breaches of the duty of care. And indeed, we see that in AMC's articles of incorporation. What they are doing is expanding an existing clause to say, not only are the directors going to be exculpated, but we're going to get in compliance with the change in the law and add some protection for officers of the company as well. Like directors, it goes on to say here in blue, officers may not be exculpated for claims for breach of the duty of loyalty. They cannot be exculpated for acts or omissions not in good faith or which involve intentional misconduct or a knowing violation of the law. That is important for you to know. This is not a carte blanche let's get them a get out of jail free card. This only addresses breaches for the duty of care. Also, they are not exculpated for any transaction from which the officer derived an improper personal benefit. It goes on to say in green, unlike the protection available to directors, officer exculpation will only shield officers against direct claims brought from shareholders. So if you wanted to sue one of the executives personally, they would have protection under this, but they are not protected against derivative claims. So if you were to sue on behalf of the corporation against one of the officers, they are not even protected from that at all. It is also important to note that this does not give them any protection for things that happened in the past. So if you vote on this, if you choose to vote on it, it does not absolve them from any duty of care violations prior to the date that this change is made in the Articles of Incorporation. So are other companies doing this? That's a good question to ask, and that's one that I asked myself. It says here, between August 1st, 2022, when the amendment became effective, and July 5th, 2023, 279 Delaware corporations included a proposal in their proxy statement requesting stockholder approval or a charter amendment to adopt an exculpatory provision for officers. Stockholders approved such proposals at 221 of these companies, or 79%, and did not approve them at 42. Here is a second article from Baker Botts, another well-respected law firm, 2 companies incorporated in Delaware. We strongly recommend each Delaware corporation consider implementing an amendment to its certificate of incorporation to exculpate its officers from personal liability for monetary damages, and that newly formed Delaware corporations include a charter provision to the same effect. We believe this protection for the benefit not only of the officers, but also of the corporation and its stockholders will quickly become standard practice among Delaware corporations and demanded by sophisticated and well-advised officer candidates prior to accepting their roles at any Delaware corporation. Again, I'm just highlighting this information to show you, and you can go out and find many other examples of this. Law firms which advise Delaware corporations are encouraging, pushing all of them to implement these changes. And as we just talked about, over 220 have already pushed through these votes on their proxy statements over the last year. You will see more coming. Why do I mention that? Because this is not an AMC specific proposal. They are just falling in line with what other Delaware corporations are doing to provide protection to their officers. Again, it's your vote to decide how you want to vote on this one, yes or no. Item number 6, to ratify the appointment of Ernst & Young LLP as the independent registered public accounting firm for 2023. Vote however you'd like on this one. It's on the ballot every year. I always chuckle, though, at the sentence they tuck in at the last paragraph that says, if the stockholders fail to ratify the selection of this firm, the audit committee may appoint another independent registered public accounting firm, or they may just decide to maintain its appointment of Ernst & Young. So it seems like it's more of an advisory vote than one where we have any real say. Proposal number 8, very short and sweet, allows the company to adjourn the annual meeting if they need to, if there are not enough votes to adopt the above proposals. Let's finish up talking about proposal number 7. To conduct a non-binding advisory vote. That means that you're going to give them your thoughts, but they get to do what they want. A non-binding advisory vote to approve the compensation of named executive officers. There are 36 pages going through the compensation, and I again encourage you to read them all, but I'm just going to highlight a couple of things here. Number 1, it gets brought up a lot, are the executives loaning out their shares and making money by giving their shares to shorts, making all that sweet, sweet share lending money. AMC does have a anti-hedging policy and a anti-pledging policy. You can find it every year in the proxy in the compensation section. Under our insider trading policy, directors and officers are prohibited from engaging in short sales or investing in any other kinds of hedging transactions or financial instruments, including puts, calls, prepaid variable forward contracts, equity swaps, collars, and exchange funds that are designed to offset any decrease in the market value of the company's securities. In addition, under the insider trading policy, directors and officers are prohibited from utilizing the company securities in a margin account or pledging the company's securities as collateral for a loan or other obligation. And you know that the only way that you can get the share lending, if you were lending out your shares, would be to have them in a margin account. So I think the compensation committee has this pretty well covered. And as always, if someone were violating this policy, they ought to have the book thrown at them. But we have no evidence of that, just lots of allegations constantly being thrown out by various trolls on Twitter, Reddit, and YouTube. A couple of other questions I had for myself as I was going through these 36 pages. Adam Aaron's executive compensation here for 2022 is listed as base salary $1.5 million, stock awards $16.1 million, non-equity incentive plan compensation $6 million, total $23 million. And I wanted to really dig into this $16 million and see, did he really get 16 million new stock awards in 2022. And so what I did was scroll down to page 60, the grants and modifications of plan-based awards. And this covers the RSUs and the PSUs from 2020, 2021, and 2022 that he still has coming to him, because he doesn't get 100% of that bonus every year. It's spread out over several years. And sure enough, if you add up these numbers in the last column right here, 5.2 million, 1.7, 6.2, and 2.9, that is where this 16.1 million comes from. The numbers down in that table add up exactly to this amount right here. So he didn't get 16 million in 2022 stock awards. It was cumulative vesting going back all the way to 2020. I just thought that was interesting for myself to know. The other thing worth knowing, if you read through all of these pages with the RSUs and PSUs, is that the bonuses that they get are aligned with shareholders by focusing the bonuses based on adjusted EBITDA and free cash flow, and that they make some adjustments based on the compensation committee's expectations for domestic and international box office. And if the box office ends up being more or less than what their expectations were, they might adjust those bonuses. So the idea I guess, that the compensation committee has is that by choosing adjusted EBITDA and free cash flow, they are incentivizing the officers to focus on things that would benefit shareholders and benefit the share price, bringing in profits and improving free cash flow. I get it. Compensation is a very personal topic. I will divulge. I've said this before. I voted against the compensation package in 2022. It's only an advisory vote anyways, but I did want to send a message last year. And again, do what feels right to you. Certainly, I understand that people are upset that these executives are making such lavish bonuses while we, the shareholders, are losing money and the company is losing money as well. I urge you to vote your heart, vote your conscience, and vote whatever feels right to you for 2023. As always, I want to thank you for your time. If you made it all the way through this video, hopefully you got some value out of this. Please share it on social media, hit the like button, hit the subscribe if this is your first time here. Again, I am not here to tell you how to vote. I'm not going to tell you how I'm going to vote. I am a shareholder of the company and nobody pays me. This was all my own work. Thank you for watching and I will see ya on the next video.